From poison pills to Elvis quotes to threats of cutting board paychecks to zero, Twitter shares are actually looking awfully resilient at this hour as the corporate soap opera plot starring billionaire Tesla CEO and self-described free speech absolutist Elon Musk thickens. So far today, Musk, who last week made that $43 billion bid for the social media company, has promised via tweet that if his bid succeeds, quote, board salary will be zero. So that's around $3 million a year saved right there, end quote. This weekend, Musk outed the board members who own very few Twitter shares and questioned whether their interests are truly aligned with that of common shareholders. Shares remain volatile after Twitter's board members unanimously adopted the poison pill strategy back on Friday, a shareholder plan that reduces the likelihood that Musk could gain control of the company. So right now, with shares up 7.5%. We know that Musk then took to the platform on Saturday to tweet, quote, love me tender. Of course, those are the lyrics from the late Elvis Presley song, which then sent Wall Street into a whirl of speculation that Musk is looking to put in maybe a tender offer for the little blue bird. Let's bring in investor Dan Niles of the Satori Fund. He bought Twitter shares last week, but is already out of them. He says he's got way better investment ideas now. In a Fox Business exclusive, Dan, too much drama? Why did you buy it last week, and then why did you sell it?
It was too much drama for me. I mean, if you look at Twitter from a very big picture standpoint, the day they came public, the stock closed at $45 a share. It's not much different today. In the meantime, you look at the S&P 500, it's tripled. You look at Facebook and Google during that same period, they've gone up 4 to 5x. Stock still trades at a 60 PE. It's up almost 50% off of its lows, a few weeks ago before Musk started buying. And at the end of the day, the board, I do think, their interests aren't aligned with shareholders. And so it was just too much drama for me. And I've got other names that are at much lower valuations that, I'd rather be involved with.
Yeah, we'll get to that in a second, because our viewers love to hear from you about the thoughtfulness you put into those. But when you talk about not aligned with board members, you had Jack Dorsey, the co-founder, who used to be the CEO, come out swinging as well. And he really took a swipe at board members. What does that mean for common shareholders of Twitter? If you were a common shareholder right now, what would you do?
Well, I mean, again, the stock hasn't performed, as I said, for the last 8+ years. And you're sitting at a 60 PE. I do believe the right thing is for this to come under different leadership. If you want the business to do well, I mean, you think about that. You go, Facebook and Google are up 4 to 5x during the same period of time. But, as a common shareholder, if this is a small portion and it's sort of, you're going to take a swing at it, sure. But I think, I'm always trying to get the best risk-adjusted returns, not just pure returns. And you have to look at this name and say it's up a lot already off of the fact that Elon Musk is involved. And so for me, if this somehow falls apart and the board has put in a poison pill, which tells you they don't want to cooperate, the stock could drop obviously quite a bit, especially given what we're seeing in the internet space with, advertising potentially starting to weaken, et cetera. That makes it difficult for this name, especially given its history.
Yeah, well, we'll continue to watch it. But Dan, a lot has changed since you and I last spoke a few months ago, namely a war broke out. Tell me exactly what the trends are that you are witnessing and how you are investing through those trends.
Well, remember, we entered this year believing that the S&P would be down at least 20% peak to trough. So that's the big picture. Since then, you add in the war, and the war has just increased the odds of it being worse than that, because oil was already at $92 a barrel before Russia ever invaded on February 24th. So you look at this and you say, this just makes the long-term situation even worse from an inflation standpoint, even when peace gets declared, because the sanctions aren't going to come off. So you look at how much of revenues for a lot of these S&P 500 companies comes from outside the U.S., which is roughly 30%, between Europe weakening because of this war, specifically Eastern Europe, but that also ratcheting into Western, plus Shanghai getting locked down by China, so they continue to have the zero COVID policy. This genie's not going to get put back in the bottle, but that's slowing growth. that creates a lot of risk going into earnings. And this is the first time, I think, in 7 quarters, you're going to see numbers starting to come down since the pandemic began. And with valuations this high, it's tough to be bullish.
And you have said that you're seeing money flows shift. They're coming out of one area and into another. Can you expound on that for our viewers?
Sure. I mean, it's pretty simple. If you think about during the pandemic, the last 2 years, I mean, I haven't been on a vacation since before the pandemic, and I'm sure a lot of your viewers have as well. I went to my first indoor sporting event since the pandemic quite recently. And so during the pandemic, everybody was buying stuff. So they're buying PCs, smartphones, Peloton bikes, but they weren't going to restaurants, going on vacation, getting on an airplane, going into movie theaters, going to a sporting event. And so that's where I think people are shifting to, because I'm going on a vacation this year. I'm sure a lot of your viewers are too after a very long time. And so it's switching from goods to services. And during that switch, I think much like you saw a lot of companies beat numbers, very strongly during the pandemic that benefited from it in things like, video streaming or e-commerce. Now you're going to see companies in areas like hotels, airlines, cruise lines, et cetera, benefiting as you go through the rest of this year. And so those are the types of names that we're long.
And you're long, let's put it up, Airbnb, Uber, Hyatt, Norwegian Cruise Lines, CCL, Carnival Cruise Lines, and you love, I believe, the airline. Can you just give us a line on why you like regional banks, Dan, as well?
Sure. That one's, if you think about the macro backdrop, companies like JP Morgan had big reserves against Russia. They talked about $1 billion in losses over time from that region. So if you're a big multinational, that's a problem. The fact that the IPO market isn't that strong or the M&A environment isn't that strong hurts you for fee income. A bank sitting in the middle of Tennessee doesn't care about that. What they care about is you can't go to the Fed for free money or the government for free money, so you're coming into the bank to get a loan, and they can charge much more interest on that loan. The spread between the 5-year interest rate and the 3-month interest rate, which is what you get for putting your money into the checking account or savings account, that spread has widened from about 120 basis points to over 200. So they can make a lot more money on those loans. That's why we like the regional banks quite a bit.
And he is buying KRE, the ETF. You get a whole basket of them. Dan, great to see you. Thank you so much for joining us.
I appreciate it, Liz.
We are coming right back. Stay tuned.